Welcome back to Floss Law. Hard money lenders. We're talking about hard money lenders on today's episode. But first, before we get to that, thanks for coming back. If you're watching us on YouTube, if you hit subscribe, like, comment below. If you're watching on social media, follow along, add me, and like and share with anyone that you want to. So today's episode, we're on day 7. 10 days for the next 10 years. 10 days worth of videos to give you everything you need to know to become a real estate investor, so that 10 years from now you won't be looking back at goals that you set for yourself to become a real estate investor and still not own property. There are far too many people that set goals back in 2010. We're now at 2020 in a new decade and still trying to find their first property. So we're going to get you over that hump, get you involved with real estate. Today's episode 7 or day 7, we're dealing with hard money lenders. What a hard money lender is, and understanding how to use hard money safely so that you minimize the risk of your property. So what's a hard money lender? Let's talk about it. It's easier to talk about what a hard money lender is not. So you're used to dealing with a conventional lender that's going to lend you money on your house, or your commercial lender that wants to lend you money to buy commercial property. You could have different circumstances. If you deal with FHA, they'll let you do 3.5% down. Conventional is 20% down. If you're dealing with a commercial lender, they want 30% down payment. When you're going through the process of applying for that mortgage, you're dealing with the bank, you're dealing with your mortgage broker, you're dealing with the bank representative, you're dealing with people. But ultimately, all they're doing is putting your package together, and they're sending it off to third-party people within a bank or underwriting department or whatever. And then sometimes it's even going to an additional layer where they're reviewing your loan package from the mindset of the investor, of the bank, of whoever is going to be funding the property, and determining if you're a safe investment for them. And they're going to want to look at your tax returns, your pay stubs, your bank statements, all that type of thing. And they want to make sure that they're eliminating as much risk as possible, you individually as the borrower, for the bank. So if you're someone who wants to start getting involved with either fix and flipping residential houses, or if you want to buy income property, you want to buy 2 flats or 3 flats, or you want to buy a 12-unit apartment building and it needs a lot of work done, needs a gut rehab, going into a bank or going to a mortgage broker and getting those done. You can't get those done. You can do like a 2 or 3K loan or something like that, where you can purchase the property and borrow on the rehab, but it's a long, exhaustive process. The far easier method is to go with the hard money lender. So you have the banks over here with their strict rules, and they're looking to minimize the risk for the bank, looking at you, the borrower. And then on the opposite side of the spectrum would be the cash buyer, where you have cash ready to go. Somewhere in between there, you have the hard money lender. A hard money lender is someone or an institution that's lending money that is either their own money or money that's been invested in their company from other investors, or they're applying capital that they have on hand. They're willing to take bigger risks and underwrite the actual asset, the actual property that you're doing. So if you go to a hard money lender and you say, hey, I have this house, I want to do a flip on it, I have it under contract for $100,000, and I need to put about 50 grand into it, and I know when I put that 50 grand into it that it's going to be worth 200,000. They're going to obviously do an appraisal, make sure that what the numbers you're giving them are going to match up. But they will be much more willing to lend on those deals and take risk of the investment with you. Even more so, they will take a higher amount of risk to go into that property with you. So there are hard money lenders that, if you're saying, I want to do this rehab project, will give you 80, 90, maybe even higher of the mortgage on the purchase price, and then will lend sometimes upwards of 100% of the rehab costs. So if you have that same property that you have it under contract for $100,000. It needs 50 grand worth of work. You may be able to go to a hard money lender, and they'll say, look, we believe in the project. We think that it's going to work. We looked at the end numbers. We looked at the $50,000 estimate of rehab that you gave us. We agree with all the numbers. We think everything looks solid. So we're going to lend you $90,000 for the purchase price, and we're going to lend you the 50 grand you need for the rehab. You just need to bring the 10 grand for closing on the purchase end, and then we'll finance the rest. And then we'll give you depending on what lender you go to, they may give you all the rehab costs. They may say we need to minimize our risk, so you need to start the rehab out of pocket. And then as you complete percentages, we're going to give you a draw. So once you hit 25% completion, we'll give you 25% of the 50 grand. Once you get to half, we'll give you the half. Do that, or they may just break it up into thirds, or they may just have you on a set schedule. Look, when you get to halfway point, we'll give you the half of the money, and then when you complete it, we'll give you the other half of the money. I've seen a lot of different structures with that. Doing a draw is not a bad idea. Even if you're really good at this, sometimes giving you all the money at one time can, it's too much cash to have on hand. It throws off your budget sometimes too. So sometimes it's good to kind of break that out a little bit. But I do have people that take 100% of the money and they have a set schedule, and it's not a problem for them. So what's the drawback then? This sounds too good to be true. This sounds too good to be true, Bob. How can I go to a lender? If I go to a bank, they're not going to give me a loan to do this rehab. But if I go to this other place you're telling me to go to, they're going to give me money to buy it and money to rehab it. Well, that sounds crazy. Multiple things we're going to talk about right now as far as your risk with hard money lenders and what you need to know with a hard money lender going into it. Number one, anytime that someone is assuming part of your risk on the deal, they're going to be compensated for that. This kind of mirrors what we talked about the other day about apartment buildings. When you're buying an apartment building, we want to place value on risk. We're always placing value on risk. Same thing for a lender. So the lender is going to place a value upon the higher risk that they're putting on the property. So if you took out a regular mortgage from a bank, you might have an interest rate of 4, 4.5, 5, depending on your credit score. If you go to a hard money lender, they're giving you all this money. In return, they might be giving you an interest rate of 9, 12, maybe even higher if you're a riskier person. If you have a shoddy credit history, they might say, look, we'll take a chance on you, but you're going to have 15% interest on that property, which is a lot. That's really, really high. In addition to that, the closing costs are going to be high. So the closing costs that you're paying on the purchase are going to be much, much higher than what you see when you're doing a residential loan or even a commercial loan. So it's not uncommon to see 1 or 2 points get charged on the purchase. A point is a percentage of the overall loan. So it's not uncommon, and I've had some clients even walk away from a loan deal before, from a hard money loan at the closing table, because you may be barred. So let's go back to the example we're going with. You have that property buying for $100,000. And you need the 50 grand rehab, so your total loan you're taking out is 140, you're bringing 10 grand. Well, turns out that 50 grand that you're borrowing is now what you're actually going to get at the closing. So there's closing costs are involved, there's points that are involved, there's things that they're going to charge you as part of that loan application. So you think that you're going to walk out with the 50 grand for the rehab. But by the time you get done with the closing costs, you're actually walking out maybe with closer to $40,000 for the rehab, because they're loaning you the 50 grand, but then they're charging all of these fees on there, which then lowers the amount of money you're actually walking out of the purchase with. So you need to keep that in mind. This money isn't free, so you're actually being charged interest on money that you're then paying back to them. So Just, you don't have to. Some people get like angry, like, oh, that's not fair. It's perfectly fair because they're taking a gigantic risk upon you and taking a gigantic risk on that property. So of course it's going to cost more money. I mean, that should just be intuitive. It's not unfair for them to give you almost all the money for the purchase and the rehab, but it's unfair that they're charging you, a lot of money for it. Money isn't free. Oh, I want you to always understand the money isn't free. So if you're getting this crazy deal on getting all this money for the rehab, of course it's going to cost money. You just need to incorporate that in. You need to know that. All right. So there's high closing costs. The interest rate's going to be high. It's very important that we focus on that. So if you're thinking about doing hard money loan on the rehab of either, a fix and flip residential, or we use hard money a ton in commercial property. So, you could do sometimes 2 or 3K loans, which is an FHA program where you can borrow the money for the rehab, sometimes for like a 2 or 3 flat or something like that. But it's hard to get those done. We can get them done, but I have a lot of those deals that unfortunately don't go together too, because they're very difficult. There's a lot involved, there's a lot of paperwork involved. A lot of my investor clients, when they're doing, especially when you're doing an apartment building, are going to go to hard money because they know they can get it done. Oh, quick point. When you're doing hard money, because it is their own money that they're lending, it's way quicker. I should point that out. One of the positives with hard money, that why a lot of investors go to it, is because of the timeline involved. So if you're doing a regular loan, like a residential loan, it might take you 30 to 45 days. If you're doing those 2 or 3K loans, it might take longer. When you're doing a hard money loan, if you've already qualified, like if you've already talked to that hard money lender ahead of time and they're familiar with you and you've maybe sent them some of your financials have been qualified by them, we can get those things closed in like 14 days. They underwrite them extremely fast because it's their own money, it's their own department looking at it. So they fast track that. They make decisions very efficiently and very quickly. So depending on the company you're working with, and especially if you've done one with them before, now you have a track record, sometimes you could be closing them in 10 days. It's a really, really quick turnaround. So, which helps investors sometimes, because if you're making a hard play on a property, particularly income property, maybe you're making a hard sell. Look, I'm a cash buyer, I have cash on hand, here's my proof of funds. And then you go to, we go into escrow, we're getting ready for closing. Sometimes the investor will come back and say, look, I have the cash to close on it, but I'm going to send the contract over to my hard money guy. If he can get this thing done in the 10 days and we have the loan package ready to go, I'm going to go with the hard money lender. I'd rather use someone else's money than my money. And you'll hear investors talk about OPM, other people's money. We're weighing these two options right now. The two options are you unwilling to pay the high points and the high percentage for a hard money loan? Or, and this is where you have to figure out where you fall in this camp. A lot of investors are willing to say, look, as long as I'm using OPM, as long as I'm using other people's money and it's not my money coming out of pocket, they can charge me whatever they want because it's not my money. So as long as I can get the project completed and I can get the project, I can get my exit strategy completed where I can get out of the property and get out of the hard money loan before it starts to make me have to go out of pocket, they can charge me whatever they want. As long as at the end of the day, I'm walking away and I have money, I've made a profit in my pocket because I didn't have to come 1 red cent out of my pocket. I'm using all other people's money. So any profit I make at that point, I came out ahead. So it's different mindsets. Some people are not willing to do that. Some people are not willing to let, because if you don't do, here's the risk. If you don't have your project lined up right and you don't have your exit strategy is either how you're going to refi that loan to get out from under that high interest rate or selling the property. If you don't have your exit strategy planned out and able to execute it, if you end up having to hold a hard money loan for a long period of time, it's going to kill your profits. Hard money loans are not designed for you to have it on the property for a long period of time. I cannot emphasize that enough. I love using hard money. I love the idea of, this is my bias right now, I love the idea of if you can use someone else's money and you can still make profit at the end of the day and they're making their money and everybody wins, then I don't care if they make a lot of money. Who cares? They're making money, you're making money, everybody's happy. If you focus too much on the hard money lenders and what they're making, you're not coming out of pocket for any of your cash. So what difference does it make? Here's the problem. You have to be able to get out from that loan. If you're going to hold a property for, say, more than, I will put the threshold at 6 months. Anytime we've had a property more than 6 months, the hard money loan on there, that interest is so high, it really starts bleeding out the profit on the project. So the ideal is obviously 3 months. 3 months is the ideal turnaround time when you're doing like a fix and flip. If you can be in and out in 3 months, that is the gold standard for getting in and out of a property. We use 3 months because seasoning requirements, if you have like an FHA buyer, is 90 days. So if you want to sell a property to an FHA buyer, which is a huge pool of buyers right now, the seasoning requirement is you as the seller have to have owned the property for a minimum of 90 days. So we want to have the property under contract on day 91. That's the gold standard. That's what we want to hit every time. If we're still working on the project and we're now at the 6 month marker, you're really in danger of now losing money on the project, because that high interest payment every month is now depleting the profits of the end result of the project. What you're walking away from at closing, the check might be big, but then when you go back and incorporate in your holding costs, if you're paying monthly, it really ate into that. It really ate into your profit. So if you're doing hard money, I encourage you to do it. I think it's a great avenue to go, especially if you're working with commercial property, because it makes the acquisition so much easier. Just have a very crystal clear exit plan of how to get out so you don't get stuck with it. I've seen commercial investors say, you take the hard money, and an example would be, this isn't a real example, I'm making this up, but I'm doing an aggregate of experiences that we've had. So say you're purchasing the 2 flat for $40,000, and you get the hard money lender to go in where they're lending you the $40,000 for the purchase, and then they're lending you maybe the $80,000 you need for the rehab. So you're total in for $120,000. And if you get familiar and you get a track record with a hard money lender, I have seen hard money lenders go up to 100% with investors, 100% purchase, 100% rehab. But that's when you have a sterling track record. That's when they know this guy or girl's solid. We know that they know what they're doing and they can get these projects done, so we feel comfortable doing that. We can minimize that risk. So now you're into the building for $120,000, you get it done, you rent out both units, and now it's cash flowing, and maybe now the building's cash flowing a net of $20,000 a year. So you take the appraisal method, the building made a profit of $20,000 a year. We multiply that by 10, typically is what we do for the income method, income appraisal method. So now the building's worth about $200,000. You're going to go to a commercial lender. Now, a commercial lender is going to take that same amount of risk, but now you've stabilized the building. It's cash flowing, you've done all the repairs, everything's good with the building. So they'll say, all right, I appraised out for 2, but it's a commercial lender, remember, so they're only going to lend out 70%. You have to have 30% down. So they're going to lend you 70% of that $200,000, which, if you've done everything right, obviously pays out that hard money lender. So you're switching to a stabilized loan with a much lower interest rate, and you're paying off that hard money loan so you can get out from under it. Depending on what commercial lender you go to, though, can cause you a problem. So, and we've dealt with this many times over the years. Maybe you go to a commercial lender and they say, great, we'll lend you on this property. Go to the hard money lender, get it stabilized. Once you get it stabilized, come to us and we'll put the regular mortgage on the property, commercial loan on the property. And then you get done and they go, well, but our lending requires you to have 12 months of rental performance on the property. We don't lend on 6 months rental performance. You have to have it fully leased and performing, have performance history for a year before we're going to give you our loan product. So now you're settled up with this hard money loan for 12 months, which, if you figured out by now, not a good thing. Now you're that other 6 months you now have to hold that property for, you're just bleeding out money because it's not designed for you to hold, for holding properties with. So you need to make sure, number one, that you find a good hard money lender, you build up a rapport with them, they feel comfortable with you. But part of using a hard money lender is you need to make sure that you're having conversations with who's your end exit lender going to be. Now, obviously, if you're selling the property, it's not as much of a concern. So this doesn't affect you doing fix and flips. If you're doing fix and flips, your main job is just get the rehab done and get it on the market. That's it. That's all you got to worry about. But we're talking about right now, if you're using a hard money loan for buying an income property, buying an apartment building. So you do the gut, you get done, you have it rented. Now you need to turn around, you need to do a refinance to put a stabilized commercial loan on there so you get out of that high interest rate hard money loan. You need to be talking to both. So before you're even in the property, before you're even buying the property, you're not only applying with your hard money lender and talking to your hard money lender, but at the same time, you're opening up the line of dialogue with your commercial lender to find out if they're going to give you the end product so that you can refi out. You cannot get stuck with these hard money loans on these income properties. You cannot. You have to figure out, and I've seen guys get taken down, unfortunately, because they hurried up and got the hard money loan, and then they found out that they couldn't get the end financing, or they were going to have to hold the property for a year or longer to get the end financing. And that period of time, just they were at a negative for the first year in the property. They're coming out of pocket because the interest ate into the project so much. So you need to be having a conversation with both. You need to be talking to your hard money lender and getting the hard money loan done, but at the same time, you're sending that property to your commercial contacts and saying, hey, I'm buying this building. Do you have a loan product for me on this building? And they may say, yeah, we have a product that will be available for you in 6 months, or they may say we'll have a product that's not going to be available to you for a year, or they may say, and I've had this before, we have a product now, but it's not going to be there in 3 months. So you're trained to think like residential lending. Residential lending, you're used to, it's always there, the interest rate may fluctuate, but there's always residential lending. Commercial lending fluctuates. So we can have products on the commercial side open and close. It's not always one set thing. There will be better opportunities with better loan packages with better interest rates for particular asset classes and particular areas for a particular period of time, and then it fills up and it closes. And then you can't get that really good package anymore. I remember one time having a commercial lender say, hey, we had this particular bundle that opened up. If you have at least 2 to 3 flats within these 10 zip codes, you can get this loan term. And it was a really, really good loan term, like a fantastic loan term. But you had to meet this very specific set of criteria. And I had a client that was in a situation where he had 4 and he needed a 5th one in order to apply for the loan. And we got caught in this very odd situation where we were running around trying to debate whether to just let it go, or to hurry up and buy a fifth 2-flat with cash in a hurry just so we could apply for the loan for the client because it was such a low interest rate with such good terms that he really wanted to be able to do it. And at the end of the day, we ended up not doing it because I showed him what was available for him in these particular zip codes. And he's like, look, I'm going to have to overpay to get the lower interest rate for the other 4 properties, which I'm taking from, what's the phrase, we're robbing Peter to give to Paul. He's like, I'm just taking bad money here to make better money over there. He was like, it doesn't make, he was basically like, I'm going to offset, so it doesn't make any sense to even bother with it anymore. But stuff like that can happen, which is the importance, again, can't emphasize this enough, of networking. If you're going to get involved with commercial and investing, you have to network. You have to get around people. You have to know, hey, this very specialized product was available. The only reason the investor knew about it is because he had made a contact with a commercial lender, and they called him and said, listen, it just opened up. This is probably going to be open up for a couple months because people are going to apply for it. Once it fills, that's it. It's done. It's going to close out. So know that. Communicate with your commercial lenders and know what's available to you. It's part of the reason why I shouldn't say a lot of investors. I want to be careful here how I phrase this. It's part of the reason that we see issues with people who accumulate single-family home portfolios. So I have a few clients doing that right now. When you accumulate single-family home portfolios, so if you buy a bunch of houses, you have them all rented out. It's very low management. So from that, the investors like it because typically when you are renting out a single family home, you're going to, in the lease, have the tenant be responsible for taking care of the property. You got to mow the lawn, you got to shovel, you got to do all that kind of stuff. So it really lowers your management responsibilities. You got to make sure nothing's leaky, nothing's on fire or anything like that. So from that standpoint, they like it. One of the major drawbacks of accumulating single-family home portfolios is they are a major pain in the butt to refi. So you've applied all of this money into buying all these houses, but unless you were buying the individual houses with mortgages, or maybe you were either using cash or a hard money loan or something like that, when you go to refinance them, for whatever reason, the banks hate doing refis on them. You have to have a huge portfolio. You have to accumulate like 10 or 20 of them, and then they'll let you do the refi. But if you do one house and then you rent it out and you try to do refi the one house, good luck with that. It's a pain. It's a huge pain. You could get it done, but they make you jump through hoops. And to be honest, they just don't want it. They really don't want it. They don't like it. So they're not gonna follow up with you, and they're gonna treat you bad. They just don't like working with those. It's a huge amount of follow up. It's a huge amount of paperwork, and it's a pain just to get them to give you the loan on that portfolio. So from that aspect, that's why we see people typically get burnt out a little bit on single family and make the jump over to investment property, the 2-flats. Even when you just make the jump from a house to a 2-flat, the lending is night and day from each other because it's more of a rental property. It's a different asset class, and they're more willing to do those loans and do the refinance of that property. I'm talking about refinance a lot because it's important. If you're going to do hard money, you have to become extremely proficient on doing refinancing. You have to become extremely proficient on finance and doing refinancing of properties. If you get stuck with a hard money loan on a project, it will kill your project. You have to be able to get out of them. Despite all the risks, I still love hard money. I still love hard money. I love using it. I think hard money is still the best vehicle if you're going to acquire like an apartment building or an investment property that needs a lot of work done to it. It's fantastic. It's still one of the best things out there. I have a tremendous number of clients that do fix and flips that all they do is use hard money. They're always using someone else's money for doing fix and flips. For the very same reason, they don't have to employ any of their own money out of pocket. So that's essentially hard money in a nutshell. I know it's not. It seems kind of short and it seems overly simplified, but there's not a whole lot to hard money. It's just that people don't seem to understand either what it is or how to use it. All you need to know from hard money is you're paying for the risk of the investment. You're paying high points at closing. You're paying high interest rate. In return, you're getting to use a massive amount of money, bringing minimal out of pocket, and you need to know how to have a very specific exit plan for that property with the hard money on there. If you can satisfy all those, I say do hard money all day long. All day long. Just make sure you have a very clear plan. You can't go in. We should also talk for just a second. If you're going to do hard money, you're submitting your rehab estimate to the hard money lender, and they're relying upon that from you. They're not going to, they may tell you to adjust some numbers a little bit here and there, but more often than not, they're relying on your rehab estimate. So if you get into the property and your rehab estimate you realize was completely wrong, you're going to have to come out of pocket to rectify that. If you have like a private lender or private investor, which we're going to talk about tomorrow, you could possibly go back to them and ask for additional money. Say, hey, look, in order to do this project right, we need a little extra money. And they may do that, or they may say no. With a hard money lender, whatever they've given or whatever your loan is, you're locked in for that. So if you said it was a 50 grand rehab and it turns out, oh wait, we found some structural stuff, it's going to be 70 grand rehab. In order for you to be able to sell the property or even refi the property, you're going to need to come out of pocket for the other 20 grand. So it's important that you understand that. You've come out of pocket zero, but you're assuming the risk that if something does come up, if there's a oops, if there's a surprise, there's a oh my god, we found this, that's your oh my god, that's your surprise, and you're going to have to figure it out. So know that you need to have cash reserves, and usually any good hard money lender is at some point during the approval process going to want to see what your cash reserve is. They're going to want to know, and that the first and foremost, their risk assessment is, if this project goes sideways, do you have the cash on hand to continue to pay the monthly payment to us? And do you have the cash on hand to be able to complete the rehab so that we can get out of the property? Those are their main concerns. So even though you're not taking any cash out of pocket or minimal cash out of pocket, you need to have cash on hand for an emergency situation. So if you have zero cash, they may say, look, we don't have anything here to protect us if this doesn't go right. You can't rely 100% on our money. We need to know that you have something to tap into. And you can do any number of things. I've even seen a hard money lender say, look, we'll use your 401k, but we need to know that you have something that you can pull money from to finish the project, so you don't just ghost us and walk away, and now we're all losing money on this project, because they really don't want to have to take over the property. That's not what they want to do. They're in the business of lending cash, not foreclosing or taking money back or anything, or taking the property back or anything like that. They want you to complete it. They want you to complete the project. Even more so, we'll talk about that tomorrow with private investors. One of the biggest things that people misconstrue about either doing hard money or private investment is, one of the biggest qualities that you can have is knowing that you are going to complete the project. That's such a huge point when I represent an investor. They want to know that you're not going to leave the project and leave them holding the property, and now it's their concern. When someone's in the business of lending money, they want to remain liquid. They don't want to have physical assets. So they want their money back. They don't want to have to take over the project. They want to know, first and foremost, are you going to complete the project and take responsibility, even if the project goes bad, to sell the property? That's your responsibility as the investor. So they want to establish that you're going to do that. If they see a risk that you have a bad financial history, or you have something in your credit history that would make them think, look, this guy may just file bankruptcy and head for the hills, and we're left with this property, they're probably not going to want to lend to you. You need to be able to show cash reserves if things go poorly, but they also want to get some sense of stability from you. So you need to be able to convey stability. If you don't have as much cash on hand, but you can overly convey stability. I've seen guys with questionable financial history still get a hard money loan because they made the investor feel comfortable. Look, I'm not going anywhere, and whatever happens, I'm going to stick through this to the end. And they felt, like they wanted to take a risk. Now, the interest rate, again, may get bumped even higher because they have to incorporate money on their risk, on their higher risk, but they'll still be willing to take a chance. So for some investors, that's all they need is their first chance to get in the door and show that they can try to get a project done. Sometimes that's all that anyone needs is their first chance to show that they can complete a project. All right, so you're gonna obviously, if you haven't figured it out by now, this is very relationship driven. Usually the hard money lender is going to personally know you. If you are looking at hard money lenders and you only have established a relationship with them online, I would caution you with that. Typically, I have found hard money lenders want to meet with you face to face. They want to size you up. They want to see what you're about. Remember, this is hugely about stability. So they want to see what kind of person you are. They want to know what they're taking a chance on. They want to know what they're investing in. So usually they want to see what type of person you are, what your deal is, what you're about. So I found most hard money lenders typically, if they don't have a personal character reference for you. So I've seen that where they're like, look, I've known this guy for a long time. He's good. Don't worry about it. You can lend money to him. And sometimes, vouching for him will get you in the door. Otherwise, if you don't know them, they're going to want to personally meet you. They're going to want to know about you, what your plan is, and kind of get a sense for if you know what you're doing. But they're assessing your stability, how much they trust you to use this money to apply towards this project. I really, really don't like when I see people that are advertising online as a hard money lender. Not that I shouldn't, not online advertising is bad. I should, let me back up. I see people that are, in my opinion, not really hard money lenders. So number one, what you don't want to do, and I've seen this happen. I haven't had this personally because I've reached a point where I feel I'm very good at filtering out the people who are scam artists. But I have heard cases of other people going to closing, and the person that they thought was a hard money lender never sent the money because they didn't actually have money. So how does that happen? First of all, you need to make, and you should want to meet your hard money lender face to face to make sure that they're for real. They're for real company. They're legit. So number one is, how do you spot a fake hard money lender? Number one, if they tell you that they charge 5%. I don't know, and correct me if I'm wrong. Comment below if I'm wrong. I'm always learning about new companies and new things that are out there, but I don't know of a hard money lender going under 9%. That's a legitimate hard money lender that I've done work with before. I believe as low as they'll go is 9%. If someone's online, they're saying, hey, and I see this on Facebook a lot, hey, we'll give you a hard money loan for 5%. It doesn't exist. It's fake. It's a scam. It does not exist. There's no one lending 5% on hard money because it doesn't assess the risk. It doesn't properly price in the risk. That's for the investor. No investor would fund a 5% hard money loan. No investor that I know would ever consider doing that. So anyone that's sending you that, they're fake. You also need to be careful of kind of fly-by-night hard money lenders. And what I mean by that is someone that doesn't have anything really set up. They don't have a website. They don't have any sort of established reputation as a hard money lender. All of a sudden they show up one night and there's a hard money lender. They're doing what I call hard money wholesaling. So they'll tell you, sure, I'll fund your deal. It's 2 points and 12% at closing. What that person is doing is they're going to turn around and try to find an investor to fund the deal for maybe a point and 9% or 10%. And they're keeping maybe the point, or they might be keeping, and it could, usually it's not both. So usually it'll be what I've seen, you get to closing, they say, hey, we're going to charge you 2 points and 12%. And the person who brought you the loan that's saying that they're the hard money lender got the money for 2 points and 10%. So they're getting the 2% on the interest of the loan. Or the flip side, usually they prefer the flip side, which is they're charging you at closing 3 points and 12%. But they're getting it from someone else for 2 points and 12%. So they're getting the point. They're just walking away with the cash at the closing. So they're just flipping money, really, to you. I don't like that because people have gotten burned by that before because they're not using their own money. They're not underwriting their own money. And they're relying on another person to give the money to them that they're going to turn around to give to you. That now that you're dealing with a third-party investor, that investor can just basically decide, yeah, I changed my mind, I don't want to do the deal. That happens a lot. I got to be honest with you, that happens a lot. Investors, usually cash investors, are very squirrely. Everyone thinks and we're going to deal with this a lot more tomorrow when we do cash investors or private investors, but investors are squirrely. I've had investors the morning of a closing just call and say, you know what, I looked at the numbers again, I don't like this deal anymore, I'm just not going to send the money. Click and hang up the phone, and that's it. And they're not on the hook for anything because you're borrowing the client is borrowing the money from them. They're not involved with the deal. They had no obligation. So they're just like, I don't want to do it anymore. I'm out. I don't feel like doing it. I haven't had that happen to one of my clients, but I've been at closings where I've seen that happen, and that's not fun. When that, obviously the buyer's extremely embarrassed. The buyer's angry because their person that said that they were going to send the money now isn't answering the phone because they don't have any money to send, and it's a horrible situation. It's a horrible situation. So don't get caught by hard money loan scam artists. Use reputable companies. Use ones that are well established. Use ones that have a reputation in your community that have been known to lend and fund on deals. I prefer working with companies like that we know that they know what they're doing, and I know that they have cash on hand ready to lend and lend at a moment's notice. We get a really good deal in. You send the contract over to them, say, hey, we got this deal, and they just respond, let's ready to go. Let's do this deal. I love it. Let's do this. If once you get a good hard money lender, you get a good relationship with them, they're ready to go. Like they want to know when the next deal is. Let's close on stuff. Just send it over to us. We're ready to fund it. So I greatly prefer that. I greatly prefer working with reputable companies like that. Please stop responding to just these ridiculous blind ads on Facebook. It just drives me up the wall. Sometimes I respond to them just for fun, just to see what they're about. I know that they're fake, which makes it more fun to respond to them. Then I can kind of see what their shtick is. I had a couple guys, and one guy I purposefully sent him. I toyed with this too. This is really fun. I purposefully sent an email to a guy and misspelled a ton of words and used horrible English, and said, I'm really interested in getting a hard money loan for this property. And the guy was all over me like a duck on water, which was hilarious because I really portrayed myself as being horribly just borderline illiterate in the email. And this guy wanted to fund me tomorrow. And I was like, well, that's interesting. And his whole thing was he would fund 100% of the purchase and the rehab, but now whenever you're doing any kind of property, you want to have insurance on the property. And you're gonna have insurance on the property itself. This individual, this lender, wanted me to buy an insurance policy for his mortgage that he was going to put on the property. Like you have PMI or private mortgage insurance. He wanted me to buy an insurance policy for the risk of his mortgage. I'm going, interesting way of going about it. Okay. The premium on the insurance policy was $10,000. Now, I've talked to many insurance guys over the years. They can't tell me any insurance policy where the premium payment would be $10,000 for, say, $150,000 mortgage. That's a total scam. Anyone that's telling you that you have to, and really what this person's trying to do is get you right before closing to pay the $10,000 for this fake insurance policy, and I can only imagine the money probably never shows up for the closing. So be on the lookout for that kind of thing. Some people feel strongly about not paying any kind of application fee for a hard money lender. That's not necessarily true. I know reputable hard money lenders that will charge you a fee to pull your credit and to do the appraisal on the property. So I don't know, we kind of got into, there was a sort of a line of dialogue for a long time. Well, if a hard money lender wants you to pay any upfront fees, it means they're not legit. That's not necessarily true. So don't fall into that per se. Just because the hard money lender needs to charge you fees for running your credit and doing the appraisal and those kind of things, that's fine. I'm not worried about that. But if they want you to pay just a flat fee up front, or they don't disclose what the fees are for, or they want you to do something ridiculous like this guy with the $10,000 premium for this fake insurance policy, you're not doing any of that kind of stuff. That's ridiculous. So stick with the reputable hard money lenders in your community that know what they're doing. You can establish rapport, you can establish a relationship with them, and it works out great for either doing a fix and flip, or for a very quick method of acquiring income property, just as long, and even if it doesn't need the rehab. I know we're accustomed to doing, I've been talking about doing hard money in association with the rehab. Not all the time. I have had some people, if they really need to buy a really good deal in an apartment building really fast, just get the hard money, buy the property. Don't worry about borrowing rehab costs. You're just basically using the hard money to buy the property. Hurry up, buy the property. Now that it's in your name, you get the rental income stabilized right away. Turn around and try to get it into a commercial loan as quickly as possible. I've seen people do that too. So you can use it as a ploy. Like the underwriting to buy an income property might be too hard for you. So go to the hard money guy. Get the money easier to buy the property. Get in there, get the management stabilized, get the rent stabilized, and then immediately turn around and try to get that commercial loan on the refi, because now they're not qualifying you if you can afford to buy the building. You own the building now. Now it's just a question of, will they give you a less risky loan on the property and lend so you can get out of that hard money loan with the property. So it's different set of circumstances. I've had some people use that as a method of just quickly acquiring commercial property. The only thing I would caution with that is, if you do stuff like that, be prepared to make refinancing like your full-time job. If you start doing that type of thing, remember we talked about the risks of getting a refinance on a commercial property. I've had people go that route, and you're going to be spending morning, noon, and night talking to every commercial lender underneath the sun every day, all day, trying to get refinances for all your commercial properties. So if you're well versed in finance and you feel comfortable with finance and you know a lot of people in commercial finance, I'm fine with you doing that too. Just know the risks that are involved with it. If you're not familiar with finance, just be careful. You have a hill to climb. You need to network. You need to get around people. You need to know what's out there. All right. I keep doing these videos for longer than I think I'm going to do them for. That was hard money lending in a nutshell. I thought I was going to end it like 15 minutes ago, and then there was more than I needed to tell you. I feel like there's always more that I need to tell you guys. Tomorrow, the one everyone always wants to hear about. How to do private money, how to get private investors, how to put together a deal with a private investor. It's the one everyone always wants to hear about. There's a lot to cover there. There's a lot. That's probably going to be a really, really long video, because I have to completely tear apart all of your preconceived conceptions about what it is to get a private investor, and then build you back up with everything you need to know that you don't know about doing a deal with a private investor. because 98% of what you know is wrong. So that's probably going to be, I'm probably going to start that one first thing tomorrow morning, because that's going to be a long video. And then Thursday we'll be doing joint ventures and partnerships. That's going to be a tough one, because that's a big topic. I'm probably going to do that one kind of the way I did the multifamily video and give you the high points. Then we're going to have to break it down a later date, because there's so much to cover there. And then Friday will be the fun one. Friday will be recreational marijuana in real estate. Now that recreational marijuana is legal in Illinois, come on back on Friday. We'll talk about how to deal with your tenants choking up in your property. And then if you have your tickets, if you still don't have a ticket for the U.S. Bank Multifamily Investor Summit on Saturday at University of Chicago, reach out to Tony Hardy of Marcus and Millichap. See if he has, I think he might still have a couple tickets in his back pocket. I think he's still hoarding a couple for some few last minute VIP guests. So see if he still has a couple, and see if he can sneak in there. At this point, we might be standing room, but who cares? It's all networking anyway. So there's going to be some great panels. We're going to have a great time. We're going to talk a lot about the recreational marijuana. We're going to talk about just everything. Even if you just come for the networking, honestly, it would still be worth your time. So come on out. Hope to see you, and see you tomorrow morning.